Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken. Our model portfolio is up 7.95% year to date for 2023. Here at Spy Trader Now, our goal is to beat the returns of the S&P 500 buy and hold investor. We are currently not accomplishing that goal. We're hanging in there, but we're not beating them. And I want to beat them before the end of the calendar year. So we have till December 31st to beat this return. And I'm going to show you how my portfolio is positioned and what I am doing in order to make that happen. We do a very simple portfolio with only 3 possible positions where we have shares of the ETF SPY, or we do options, but we do both calls and puts, or we're in cash. This is currently how the portfolio is invested. Each January 1, we start off with $100,000 and we build our portfolio from there, and we monitor our trades and we compare it against the S&P 500. We try to do no more trading than 1 trade per week in an effort to do this with a simple portfolio. So, if that is something you're interested in, stay tuned and continue to watch this video. Here are some past returns for our model portfolio. 2022 up 21% compared to a negative 19% for the buy and hold investor. And in 2021 and 2022, you can see that. If you want to stay tuned how I do this, go ahead, hit subscribe, ring that bell, and smash that like button down for me. Last week, the S&P 500 gained 0.79% for the week. We'll go through the charts in much greater detail later on. Here are the trades that we made for last week. We ended up selling our 3 calls. We had 3 long calls. We sold them for a loss, so we took a loss on that position. We sold to open, or sell to open, 2 covered calls because we currently hold 200 shares of SPY. And the exact option that we sold was an in-the-money covered call with the 420 strike with a 9/8/23 expiration date. We did that for about $21.55 is how much we got paid because we sold it. In addition to that, we bought some put contracts. We bought 2 of them, 395 strike, 9/20/2024 expiration, which is going out a good amount of time, just about over a year, and we had to pay for that for $13.80. Here are those exact trades. Now on my open trades, they're in yellow. The closed trades do not have the yellow. So this is how the model portfolio resides currently. Here are some of the trades in 2023. If you want to see all of the trades in 2023, head over to spytradernow.com. There will be a link down below in the description for this, as well as every single thing I am presenting to you today in case you want to explore anything on your own. Here is the equity curve for our model portfolio 2023 year to date. Here is the equity curve for the buy and hold investor for year to date 2023. And here are the 2 equity curves combined. Our goal is for our model portfolio to beat the returns of the S&P 500 buy and hold investor. We are lagging behind them by about 5% year to date. So hopefully, if my strategy and prediction comes through and the market does pull back during the next 2 months, then our portfolio is currently positioned to profit during that 2 months. So we will, at that point in time, by the end of October, be beating the S&P 500 buy and hold investor. Then for the remainder of the calendar year, which are very bullish months, in November and December, we're going to be changing, well, if the market dictates it, we will change our stance from bearish to bullish, and then reap those reward gains, continuing to surpass the buy and hold investor. So stay tuned. See if I can actually accomplish what I'm saying. Okay, now we're talking about the Fed. This is the Fed Chair, Jerome Powell. The last interest rate hike was done on July 26, 2023, 25 basis points. The next Fed announcement by the FOMC will be on September 20th. And right now the prediction is that we are going to skip the September 20th announcement, and then come November 1, we'll have another 25 basis point rate hike at that time. But let's get through this one first. We got about a month to go, just under a month before that announcement. Now we are looking at things from the presidential election cycle theory. And how it works is that depending upon the year of the presidency, you have historical rates of return. Where do we currently reside? This is 2023. We are in the third year of the presidential election cycle for Joe Biden. Historically, that has returned 16.3%. Currently, the buy and hold investor is up 14.9%. Room to grow before the end of the year. Mind you, that's for the entire year. Now we are looking at things from the bond market outlook. And the bond market is telling us to stay out of the stock market. And the bond market is also considered smart money, and the stock market is considered dumb money. Anyways, the couple of things of concern. We have an inverted yield curve, meaning that the longer term treasury yields are yielding a lower yield than the shorter term 3-month and 2-year yields. This is inverted. It's not normal. We need this to correct. It is kind of heading towards the direction of correction, where the 10-year yields are starting to come up at a higher rate than the shorter term 91-day and 2-year yields, but it's still currently inverted. It's been inverted for some time. In addition to that, we have rising interest rates. 1 year ago, the 10-year was at 3.05. Now we're at 4.34. That's a rising interest rate environment, and equities become less attractive when you can go out and go get a CD, like I just did, and get 5% on it. So if you can get an APR of 5%, then it becomes less advantageous for you to invest in the stock market, because you can just put your money in CDs or treasuries and have risk-free income. So something to think about. Now we are looking at things from a valuation standpoint, according to CMV, current market valuation. This particular data is a little aged. They haven't updated their site since July 31, 2023, but this is a very slow thing to move anyways. They don't really need to update it every day. If they update it once a month, that's fine. Anyways, we are currently overvalued by 55.7% above the modern era market average of a PE of 20.2. That brings your standard deviations to 1.4 on a chart, which means you definitely have risk in this market. Now we are looking at CNN Business Fear and Greed Index. This is our friend Warren Buffett. He's the sage of Wall Street. We want to listen to this guy. And currently on the fear and greed, we're in the middle at neutral. It can go either way. Now we are looking at things from a seasonality outlook. This is a seasonality graph going back 20 years for the S&P 500 from 2004 to 2023 for symbol SPY. We are currently in the summer doldrums. Currently for the month of August, the S&P 500 is down 3.89%. Now we are looking at this from a very long-term outlook. This is a 20-year chart monthly for the S&P 500 bull run 2009 to 2022. Corrective channel coming down, broke out, and was going straight up to the trees, to the sky, and then we hit that ceiling, and now we are coming down. We knew we were going to come down. The only question now resides how much. But we have plenty of room to come down and still remain in a long-term bull market. As long as we don't cross this line or this line, we're in a bull market. Now the MACD has clearly topped and is parallel to its signal line. It may even come down and go below it, but I suspect it won't go much below it before finding a bottom and then going up. And so this is a long term. This is on a monthly chart, so things move rather slowly here, but we want to keep our eyes on this and see how this plays out. Now this is intermediate term. This is going back 5 years. S&P weekly candlestick chart. We touched this upper trading range. We failed, came down. We're in this trading range. Now, I suspect we're going to continue to pull back. The only question is how much. We know that we have support coming in here at about 425. Then we have another support line here, which is at about 417. If you come all the way down, you have a lot of support at 390. I doubt we're going to hit 390. But the MACD has clearly crossed below its signal line at an elevated level. Are we going to get one of these? And if we are, does that mean we go from here to here, which was from about 470 all the way down to 350? I don't think that's going to happen, but we need to monitor this to see what this correction is going to look like. I believe now with the summer doldrums, nice bull run, we're due for a healthy correction. And we are still going to be in a bull market, but we are due for a pullback. Now, this is a short-term outlook. These are daily candlesticks. You can see them nice and clearly, only going back 6 months of data. We have a Fibonacci retracement here, so that I pulled it at the bottom of this low to this high, approximately. And so this way you can see the 38.2, the 50, and the 61.8. Now we didn't even reach the 38.2 before we hit that bottom and then bounced up. But I think that this day here where I did some trading, which was on 8/26, not 8/26, I'm sorry, that's the wrong date there. That's actually 8/24/23 is when I did that trading, which was on Thursday. This is Thursday's candle. I'll have to correct that, sorry. And with that trade that I made, I made it because of this bearish engulfing candle, where this large bearish candle totally engulfed the day before and closed to the downside. I think this is a dead cat bounce, and I fully expect sideways to downward action as opposed to upward action. By the way, it failed at the green line, which here you can see my moving averages. The green line is the 50-day moving average. The black is the 200-day simple moving average. And then I have a 5 and an 8 exponential moving average instead of the simple moving average. So anyways, we have all that here in the chart, and we are watching it, but we failed at, but the bottom line is we failed at the 50. And it's going to take a lot of energy for it to get above that. And that was a pretty good level of resistance too, because that is where you have some previous tops going on. And once we got below it, this now is a resistance level. When you're on top of it, it's a support level like it was here. But then it failed, that support came down, now it is resistance, and then it failed right around it on that day where it tried to break out above it, failed, came down. So we need to see. Now, if indeed my prediction is correct, and if indeed this is going to continue to roll, that means that the MACD is going to stay negative, and it's going to go and start heading further south below its signal line, which is a poor, which is a good indication that you're going to have a decent pullback here, not just a 1 or 2%er, but something a little bit more significant. So if indeed we do get that pullback and then we pull in to this 420 or so level, we're going to close out our long covered call position, our short covered call position. We'll buy to close it, and we'll buy to close it for pennies compared to how much we received for it. And then we'll hold our shares of SPY, and then when the market recovers, we'll also recover with that. And we'll get rid of our put, take on a call, and we'll recover in both of those instances. So stay tuned. Let's see if that actually will happen. Now we are looking at a ratio chart of the equally weighted S&P 500 compared to the normally weighted S&P 500. So we have 3 charts here in one. The ratio chart is the one with the red and black lines. The S&P normally weighted is in blue, and the equally weighted is in green. In normal bull markets, the equally weighted outperforms the normally weighted because the entire market is participating, as opposed to the narrowly focused stocks in the normally weighted S&P 500. So currently you can see that the normally weighted is above the equally weighted, which gives you an indication that the market is not in a strong bullish stance when it's in this configuration. Now, we are watching the MACD. The MACD has clearly topped and is starting to head towards its signal line. Normally, when you cross above the signal line, that begins the bull run, or shortly thereafter you cross. Here it crossed, but then the market came down before it actually resumed its bull market. Maybe we're in this environment, so we're watching that. The market, the normally weighted market, is definitely pulling back right now, so we want to watch to see this pullback. But once this pullback takes footing, that could be an excellent position for us to profit handsomely when this market is going long. Don't forget, next year is an election year. Everybody wants the market to be a bull market in an election year. So we are going to continue to monitor. Now, this particular chart is concerning. This is the volatility index, the VIX, the fear index. We were in the ultra low trading pattern. Then we jumped up back into this still low pattern below 20, but now we've crossed down below it, and the MACD has topped, crossed below its signal line, and slow stow is also heading south. All this indicates that the market is potentially, by the S&P 500, by the way, is this black line right here, is actually going to find a footing here and potentially go up, which is counter to what I'm saying. So for my prediction to come through, this market is going to have to go sideways to down, and this MACD and slow stow are going to have to turn around and bounce. Now, keep in mind, these are lagging indicators, not leading indicators. But if my prediction is correct, the stock market is going to go flat to down, and that would give a sideways for the VIX. And then if it does indeed go down, then the VIX is going to come back up into this channel here, potentially reach the top of it. Now we are on the Think or Swim platform. This is a 1-year chart. It's a bullish chart. Why? Because just look at the angle of ascent. You're starting over here and you're going up this way for the overall channels. This is the +2, +1, neutral, or the regression at the dotted dash green. You have the -1 in pink and then the -2 in gold. So right now we reside on the 1 year at negative 0.2 standard deviation. I have in here a couple of alerts, and I'll show you that real closely when we get to the 3-month chart. Now this is the 6-month chart. The standard deviation is at negative 0.9, so it's got room to go in either direction. And now this is the 3-month chart. We are at a negative 1.3 standard deviation. Now normally this would be real low, telling you that you're really not going to go much lower, because 95% of all trading takes place between the +2 and -2 standard deviation. But I'm betting that we are actually going to come down and potentially even go below the -2 standard deviation in the next 2 months. We'll see if I am correct. And you can see my alerts. So I grabbed the alert on the top of Thursday's bar, which is 445.22. If we go above that, that gives less credence to my strategy and more credence that this market is still continuing to rise. If we go below this low here, which is 433.01, which I have an alert to send me on my cell phone, I'll be alerted to that. That gives more credence that we are going to continue to break down and go lower. So I've got myself covered both ways to watch the market action, and this is how I do it. I just gave you a ton of information in this video. Now comes the critical thinking. What are you going to do with that information? Well, as of August 26, 2023, the market summation, according to me, your host, Ken, with SPY Trader Now, the market has dropped 5.8% from its recent high on 7/27/23. It did bounce on that low on 8/18 and went up about 2.7% before being rejected off the 50-day simple moving average. I now expect the market to pull back between the 425 level and 408.32. You can go back and look at that 6-month chart and you can see these levels and how they coincide with the Fibonacci retracement levels as well. And also the support and resistance lines. So these do line up. We're currently positioned to profit off of that pullback. I showed you my trades. We currently have an in-the-money covered call, and I've got 2 put contracts. Next week's market direction will help confirm our short-term market direction. So we need to see what the market action is next week. And you know, I've got my alerts set up to alert me in case I'm not at the computer when something goes up, when the market starts traveling. So I hope you've gotten some valuable information out of this video. If you have not done so already, go ahead, hit that subscribe button, ring that bell, and please smash that like button down for me. I wish you good trading.